You know, a trader doesn't usually learn the real market, timing rule, when things are calm. He learns it after the market has whipped him around, wrung him out, and tossed him aside like an old price chart nobody bothers to study anymore. And before we get too far, let me tie this to something familiar, because just like we talked about in the previous video on catch financial waves, before they start, timing is the hinge that swings the entire door of speculation. Now, let me speak plainly, the way a man speaks after the market teaches him a lesson he didn't ask for. Most traders think timing is about prediction. They imagine they can outguess the tape, call tops and bottoms, or bargain with a trend like it's some friendly shopkeeper willing to negotiate. But the market doesn't negotiate. It just is. And if you don't respect it, it will remind you, harshly. Have you ever tried to convince a chart to move the way you want instead of the way it's actually moving? I learned early that the market doesn't care how smart you think you are. It doesn't care about your opinions, your hopes, your theories, or your reasons. The only thing the market cares about is the pressure of buyers and sellers. That's the whole thing. And yet most traders blow up because they try to time movements before the pressure truly confirms itself. They jump in early because they feel something is about to happen, or they cling too long because they believe they're owed a reversal. Tell me, have you ever held a losing position a bit longer just because you didn't want to admit the market was right and you were wrong? The rule you learn only after blowing up is simple, but it's not easy. Wait for the market to show its hand, not for your hopes to reveal theirs. You must let price confirm your intentions before you act. You must let the tape write the sentence before you try to read between the lines. And that calls for patience, an attribute traders claim to have right up until the moment they need it. Most traders blow up because they want action. They want movement. They want the thrill of being in a position. They treat the market like a gambling hall instead of a weighing machine. But speculation is not entertainment. It is a business, and a business requires timing that is validated by facts, not impulses. Think about it. How many times did you buy just because you were tired of waiting? There's a moment in every trend, an unmistakable moment, when the tape speaks clearly. It says, here is the line of least resistance. That's the moment the trader should strike. But the amateur strikes before that, hoping he'll catch the early start of a move. He wants to be first, but the market doesn't pay you for being first. It pays you for being right. Even in the last video about catching waves early, I mentioned acting only when the swell actually forms. Today's principle is cut from that same cloth, just viewed from the other side of the tape. Let me give you an example, and ask yourself if you've lived this one. You spot a stock drifting higher, but not convincingly. The volume is thin. The breakout isn't clean. The chart looks like a man trying to walk uphill in mud. But you buy anyway because you don't want to miss out. What happens next? The mud gives way, and you sink with it. The stock breaks down, wipes your stop, maybe even scares you out of trading for a few days, and you call it bad luck, when it was really bad timing disguised as optimism. Does that sound familiar? A trader must learn to sit tight, not only in a winning position, but also before taking a position at all. Sitting tight is harder than pulling the trigger. The man who can sit tight is rarer than the man who can analyze charts. The tape reader who waits for confirmation is rarer still. But that is what separates the busted speculator from the one who endures. And let me tell you something else. Market timing isn't only about entries and exits. It's about your internal timing. Your emotions have a schedule of their own. They want to act fast when you need to slow down, and they want to hesitate when you should be decisive. Have you ever noticed how greed whispers loudest right before a top, and fear shouts loudest right before a bottom? That's why timing is as much about controlling yourself as it is about understanding the tape. Money flows to the trader who waits for the market to show strength when it should show strength, and weakness when it should show weakness. This is wealth, building in its truest form. Disciplined participation only when the odds are in your favor. No predictions. No fantasies. Just the cold truth of price and volume. The wealth Building mindset isn't about making money quickly. It's about not losing it foolishly. Most busted traders blew up not because they lacked intelligence, but because they refused to wait for confirmation. They thought they were smarter than the market. But no one is. It took me years to learn that the market always gives you a second chance, but it rarely forgives you for taking the first chance too soon. Have you ever jumped into a trade early only to see the real move begin after you were already shaken out? Timing is recognizing that the market will reveal its direction when it's ready, not when you're ready. Your job is not to run ahead of the market, but to follow it with discipline. The tape gives signs. The chart gives signals. The trend gives you a path. All you have to do is wait for harmony between the three. But many traders can't wait, and that inability costs them their capital. And here's the part that stings. Every trader who lasts long enough eventually learns this rule, but almost always after losing a chunk of money they wish they still had. It's a tuition fee the market charges for impatience. When a trader finally understands that timing is not prediction but confirmation, he begins to act differently. He stops rushing. He stops forcing trades. He stops expecting the market to move on his schedule. He begins to wait for those clean, unmistakable signals. The breakouts with conviction, the pullbacks that hold firm, the volume that supports the move instead of contradicting it. Have you ever seen a perfect setup form after you spent weeks trading mediocre ones? But the hardest part is trusting what you see, not what you hope for. Trust the tape. Trust the trend. Trust the line of least resistance. Wait for it. Let the market come to you. Because the moment you start demanding that the market do something just because you want it, that's the moment you've already lost the trade, even before you've entered it. And so the real market, timing rule that traders learn only after blowing up, is this: act only when the market confirms, and never before. And if the market gives you nothing to do, then you do nothing. Most fortunes in trading are built not by constant action, but by disciplined inaction followed by precise execution. Now think about that for a second. How many trades in your life would have been better if you had simply waited? Most traders don't realize how dangerous early action is until they've paid for the lesson in real money. Acting before the market confirms direction isn't just a small mistake. It's the very root of why accounts vanish, why confidence shatters, and why a trader wakes up wondering where things went wrong even though the chart looked promising. When I say traders blow up by acting before the market confirms direction, I'm talking about the single most common, most costly habit in speculation: moving too soon. Moving on anticipation instead of verification. Moving on hope instead of evidence. The truth is that the market doesn't owe you clarity when you want it. Traders get impatient. They want the setup to be ready right now. They want the price to turn right now. They want the breakout to start right now. And when the market hesitates, instead of waiting for confirmation, they try to get ahead of the move. They convince themselves that entering early means catching more of the trend. But entering early rarely leads to catching more profit. It usually leads to catching the pullback, the fake out, the chop, the noise, everything except the actual trend. A chart begins to show hints of strength, and the anxious trader jumps in before price closes above resistance. A stock dips near support, and the eager trader buys before the reversal even forms. A trend line is approached, and the trader assumes the breakout will happen simply because he wants it to. The problem isn't the chart, it's the urge to predict instead of observe. When a trader acts before confirmation, he isn't trading the market, he's trading his imagination. And imagination does not protect capital. A confirmed move has evidence behind it. It has volume, structure, momentum, follow through, real clues that buyers or sellers are truly in control. Without confirmation, all you have is potential. And potential in trading is the most expensive illusion in the world. Acting on potential feels bold, even clever. But it's the kind of boldness that empties accounts. The market doesn't reward the earliest guesser, it rewards the trader who waits for pressure to reveal itself. Most traders who blow up don't do it in a single dramatic trade. They do it through a slow leak of premature entries. They buy too early, get stopped out, try again too early, get stopped again, take a third attempt too early, and suddenly the losses pile into something heavy. They begin to hesitate, second guess, and shift from a rational mindset to an emotional one. Each early entry digs a deeper psychological hole, and once a trader enters that emotional spiral, timing becomes even worse because now fear and hope take turns steering the wheel. When you wait for the market to confirm, you're not being timid, you're being selective. You're recognizing that confirmation is what transforms a possibility into a probability. Trading is not about catching every move. It's about catching the moves that have proven themselves to be real. A move confirmed by the market has strength behind it, legitimacy behind it, durability behind it. It has the force of actual supply and demand instead of speculation and guesswork. But the impatience to act early feels justified because traders fear missing out. They see the chart forming what looks like the beginning of a breakout, and they imagine how much they'll make if they're early. They don't imagine what they'll lose if they're wrong. The human mind exaggerates upside and minimizes downside when money is involved. The market knows this weakness and exposes it ruthlessly. Acting without confirmation is simply giving in to that weakness. Think about what confirmation actually protects you from. It protects you from false breakouts, from head fakes, from emotional decisions, from noise masquerading as trend. When you insist on confirmation, you force the market to prove that your direction is the correct one. You're not guessing, you're reading the tape. You're not predicting, you're responding to facts, and the market rewards those who respond to facts far more consistently than those who bet on what might happen. There's also a deeper discipline in waiting for confirmation. It teaches patience, restraint, and emotional neutrality. When you wait, you learn not to chase. When you wait, you learn not to fear missing out. When you wait, you learn to trust that the market will give you countless opportunities as long as you don't sabotage yourself by acting irresponsibly. Early entries teach you nothing except how fast hope can turn into disappointment. Confirmed entries teach you how patterns behave under real pressure. Some traders argue they like to anticipate moves because it gives them better pricing. But a better price for the wrong direction is worse than a worse price for the right direction. A trader with confirmation may enter slightly later, but he enters with clarity. And clarity is worth far more than catching a few extra cents or points. It's clarity that allows you to size correctly, manage risk logically, and hold the position with confidence instead of anxiety. Acting without confirmation is like stepping on a bridge before you know whether it can hold your weight. Waiting for confirmation is simply letting the market show that the bridge is solid. It's a mindset shift from, I hope this happens, to, I see this happening. And that shift is often the difference between a trader who survives and one who burns through his capital without understanding why. When a trader finally accepts that confirmation is not optional, he begins to see the market differently. The noise fades, the emotional pressure fades, the need to predict fades. What remains is a calm, systematic approach where action is taken only when the market signals readiness, not when impatience demands action. And this is the foundation of consistent trading, the kind that timing is not prediction, it's disciplined confirmation. That simple line, when fully understood, separates a trader who lasts from a trader who lingers. Most people step into the market thinking their job is to see the future, to outsmart the crowd, to anticipate what's coming before anyone else notices. But the market has never rewarded fortune tellers. It rewards those who act only when the evidence is in front of them, not when they're guessing at shadows. Prediction feels exciting. It makes a trader feel clever, almost prophetic. But cleverness is a poor shield against volatility. The tape doesn't care how imaginative you are. It only reflects the balance of buyers and sellers, and that balance is never revealed through predictions. It's revealed through behavior, price action, volume shifts, continuation patterns, breakouts with real follow-through. That is where timing is born. A trader who relies on prediction builds a mental picture of what he wants the market to do. He begins thinking in shoulds. The stock should bounce here. The index should reverse soon. The trend should continue. But those shoulds come from personal expectations, not market facts. And when the market refuses to behave according to those expectations, the trader gets confused, emotional, and reactive. Prediction creates attachment. Confirmation creates clarity. Disciplined confirmation means you let the market take the first step. You let price prove what it intends to do before you join it. You're not guessing where support might form. You're watching for the moment it actually holds. You're not fantasizing about a breakout. You're waiting for the breakout to demonstrate strength, commitment, and participation from real market players. You're not assuming momentum will appear. You're watching for the unmistakable signs that it already has. This is harder than it sounds, because confirmation often requires waiting through uncertainty. The human mind craves certainty, especially when money is at risk. A trader might see a setup forming and feel a surge of urgency. He wants to act before the crowd acts. He wants to enter before the move begins. But disciplined timing isn't about being first. It's about being right. Being early is only helpful if the move actually materializes. Acting before confirmation is like stepping onto a staircase before you know whether the next step exists. Confirmation, on the other hand, is evidence. Evidence removes guesswork. Evidence supports confidence. Evidence keeps a trader from acting under emotional pressure. When a move confirms, you're no longer wondering, you're responding. That response is the essence of strategic timing, not the emotional timing that leads to trouble. Consider how many traders buy a breakout before it breaks out. They see the price nearing resistance and assume the breakout is inevitable. They jump in early to get a better price. But without confirmation, they're not trading a breakout, they're trading an assumption. And when the price rejects and collapses, they claim the market tricked them, when in reality the market never confirmed anything in the first place. Or think about the trader who predicts a reversal at the first sign of slowing momentum. He sees a trend stalling and decides the top must be near. But trends don't reverse just because they slow down. They reverse when the underlying pressure shifts from one side to the other, and that shift only becomes clear through confirmation. Acting without that shift is nothing more than speculation dressed up as skill. Disciplined confirmation also reshapes the way a trader manages risk. When you wait for confirmation, your stop-loss levels are cleaner, your invalidation points make sense, and your entries align with real market structure. Risk becomes measurable instead of emotional. You're no longer fighting the trend, you're following it after it's demonstrated its intent. That alignment creates smoother trades, clearer exits, and fewer surprises. There's also a psychological benefit. When you stop predicting and start observing, the market becomes quieter. The noise fades. Instead of reacting to every fluctuation, you become selective. You learn to ignore moves that haven't proven anything yet. You stop chasing potential and start responding to proof. That shift alone can reduce a trader's stress by half, because you're no longer trying to force outcomes. You're waiting for outcomes to present themselves. The truth is that disciplined confirmation is slow in the beginning, but fast in the long run. You might enter a little later than the impulsive trader, but your entries have a higher probability of aligning with the actual move, and while you wait, you develop patience. One of the rarest and most valuable traits in trading. Patience makes you consistent. Consistency keeps you in the game. Staying in the game is what allows you to build wealth over time. Some traders resist confirmation because they fear missing out. They worry the move will run without them if they wait too long. But the market offers endless opportunities. A trader who requires confirmation might miss a few early entries, but he also avoids the traps that swallow impulsive traders. Missing a trade is far safer than entering a bad one. One missed opportunity is nothing. One devastating early entry can take months to repair. Timing built on confirmation is also the foundation of trend, following, breakout trading, and momentum strategies. Every strategy that survives long-term uses confirmation as its backbone, because the market is unpredictable in the short term, but it reveals its intentions through repeated patterns. Confirmation is simply the process of letting those patterns complete their first step. And once a trader truly embraces the difference between prediction and confirmation, his entire approach changes. He stops trying to guess what the market might do and starts focusing on what the market is doing right now. He becomes less attached to outcomes and more focused on process. He stops imagining the future and starts reading the present. And that shift, patience before entry, is more valuable than speed after entry, and every trader discovers this truth sooner or later, usually the hard way. There's something intoxicating about fast action in the market. The flashing prices, the sudden momentum, the sense that if you don't act immediately, you'll fall behind. But timing in trading isn't about being quick. It's about being right. And being right almost always comes from waiting, watching, and letting the market reveal its intentions before you risk a single dollar. A trader who lacks patience tends to believe that entries must be seized the moment they appear. But most entries aren't opportunities. They're traps dressed as opportunities. A chart may twitch upward, a candlestick may flash green, volume may spike for a moment, and the impatient trader interprets these signals as the beginning of something significant. Without patience, he jumps in before the pattern forms, before the breakout holds, before the setup completes. And when the premature move collapses, he blames the market instead of recognizing his own haste. True patience means giving the market room to breathe, letting the price settle, letting the volatility calm, letting the structure form cleanly. It means entering only after the pattern confirms, not during its birth. Most traders think they need to be fast to capture profit, but what they really need is clarity. Clarity only appears after the dust settles, not during the initial chaos. Speed after entry is practically worthless if the entry itself is flawed. A fast exit doesn't fix a bad trade. A nimble reaction doesn't compensate for poor planning. Once you're in a losing trade, no amount of speed can erase the fact that you jumped in too soon. But patience before entry prevents the loss from happening in the first place. That's why patience has more leverage. It stops problems before they exist. There's an emotional angle here too. Impatient traders are driven by impulse, by fear of missing out, by the urge to do something. They treat trading like a constant battle where they must always be active. But trading isn't a race. It's a waiting game. The best setups don't appear every hour or even every day. They take time to build. And the trader who can sit still while the rest of the market churns with noise gains an advantage that has nothing to do with speed. He's not tricked by false starts. He's not fooled by half-formed patterns. He's not drawn into trades that look tempting but lack real confirmation. Picture a stock approaching a key resistance level. An impatient trader buys when the price is near the level, hoping the breakout will occur. But hope is not confirmation. A patient trader waits for the breakout to actually happen, to hold, to prove itself with volume and clean price action. One trader acts on anticipation, the other acts on evidence. Only one of them is trading with discipline. Which one do you think lasts longer in this game? Patience before entry also enhances risk management. When you wait for clear confirmation, your stop-loss level becomes cleaner and more logical. You're placing your risk below a structure that has proven itself, not below a random guess. Your risk-to-reward ratio improves because your entry aligns with what the market is actually doing, not what you assume it will do. Impatient entries create sloppy stops, awkward positioning, and trades that must be managed constantly because they were never stable to begin with. There's something else worth noting. Markets are experts at creating urgency. They move in ways that pressure traders into acting quickly. A sudden jump creates excitement. A sudden drop creates fear. Both push the mind towards speed. But the market's job isn't to give you clean, comfortable entries. It's to mislead you into reacting emotionally. Patience is your shield against this manipulation. When you hold still long enough to let the fake moves pass, you begin to see the real move clearly. Think about the difference between a trader who enters early and one who waits for confirmation. The impatient trader may seem fast, but he ends up fighting the market more often than following it. He wastes energy adjusting stops, managing stress, and trying to salvage trades that never had a strong foundation in the first place. The patient trader, meanwhile, takes fewer trades but better trades. His entries are calmer, his trades feel smoother, he spends less time fixing mistakes and more time compounding gains. Patience also supports psychological stability. When you wait for quality setups, you avoid the frustration and self-doubt that come from a string of impulsive losses. You make decisions from a grounded state rather than a frantic one. The market becomes less threatening and more readable. You begin to trust your process because your process is no longer built on guesswork. Confidence grows naturally from patience because the trades you take align with your rules rather than your impulses. And here's something many traders overlook. Patience is a form of strength, not weakness. It's easy to click buy or sell. It's easy to jump at the first sign of movement. The hard thing, the thing that requires real discipline, is to do nothing while waiting for the exact setup that fits your criteria. Patience means you're willing to let opportunities pass unless they're the right kind. It means you prefer safety over thrill, clarity over rush, longevity over excitement. Most traders burn out because they exhaust themselves on meaningless trades. They waste emotional energy trying to fix trades that never deserve to be opened. But the patient trader conserves his energy for moments when the market gives him something undeniable. He doesn't chase. He doesn't scramble. He doesn't confuse movement for opportunity. He acts only when the picture is clear. Speed after entry is reaction. Patience before entry is strategy. One keeps you busy. The other keeps you profitable. The more you trade, the more you realize that the quality of your entry determines everything. Your risk, your confidence, your ability to hold, your ability to scale, your ability to exit properly. And the quality of your entry comes from the quality of your waiting. Patience shapes the setup long before you execute it. And that understanding, the desire for action, is the enemy of proper timing, and any trader who has spent enough hours staring at the tape knows exactly how dangerous that desire can be. When you sit in front of the market long enough, something strange happens. You start to feel like you should be doing something. Even when no opportunity is present, the restless mind tries to invent one. That restlessness is the silent account killer. It pushes traders into bad entries, premature exits, reckless position sizes, and emotional trading decisions that have nothing to do with the actual structure of the market. Most people don't admit it, but they're addicted to activity. They think that being in a trade means they're working. But trading isn't measured by how many positions you take. It's measured by how intelligently you choose them. The desire for action makes traders chase every small fluctuation, every green bar, every random breakout attempt. They start treating noise like signal. Every wiggle becomes an invitation. Every spike feels like a call to enter. But noise is not opportunity. It's distraction. And distraction is expensive. The irony is that traders enter the market because they want control. Financial control, personal freedom, the ability to choose their own path. Yet the desire for constant action actually strips away that control. It forces traders to behave on impulse rather than intention. It drives them into the exact traps the market sets for the impatient and undisciplined. The more you crave action, the easier it becomes for the market to bait you into poor decisions. Imagine watching a stock drift sideways for hours. There's no clear direction, no strong volume, no meaningful pattern. A disciplined trader simply waits, doing nothing, because nothing needs to be done. But the action-driven trader feels uncomfortable sitting still. He starts thinking, maybe I can scalp this range. Or, it might move soon. I should get in before it does. He invents reasons to act because inaction feels like failure. But acting without purpose is the real failure. Proper timing requires clarity, confirmation, and structure. It requires the trader to be deliberate, calm, and strategic. But the desire for action clouds judgment. It makes the trader see what he wants instead of what's actually there. When you want a trade, you'll find reasons to justify a trade. When you're willing to wait, you'll find reasons to avoid a bad one. That difference determines who survives. The market isn't generous. It rewards the patient and punishes the restless. It hands profit to the trader who treats inaction as part of the job, not something to escape. The desire for action makes traders jump early, exit late, overtrade, revenge trade, and break rules they promised themselves they'd follow. And every time they do, the market collects its fee. Think about how many losses you've taken that started with this simple thought: I just want to be in something. That mindset is the beginning of poor timing. Entering out of boredom or FOMO means your entry is based on emotion, not analysis. Once you're in a trade for the wrong reason, everything that follows becomes distorted. Your stops widen because you don't want to be wrong. Your targets shrink because you're scared. Your management becomes chaotic because deep down you know you shouldn't have entered at all. Proper timing means waiting until the market reveals its direction. But the desire for action pushes traders to try to predict direction instead. It pushes them to jump before the signal, before the structure forms, before the price confirms. They act early, thinking early is smart, when early is usually reckless. A proper setup requires patience to form. Impulsive traders interrupt that process and pay for it with unnecessary losses.